Good afternoon. My colleagues and I remain squarely focused on our dual mandate to promote maximum employment and stable prices for the American people. We understand the hardship that high inflation is causing, and we remain strongly committed to bringing inflation back down to our 2% goal. Price stability is the responsibility of the Federal Reserve. Without price stability, the economy doesn't work for anyone. In particular, without price stability, we will not achieve a sustained period of strong labor market conditions that benefit all. Since early last year, the FOMC has significantly tightened the stance of monetary policy. We have raised our policy interest rate by 5 percentage points, and we've continued to reduce our securities holdings at a brisk pace. We've covered a lot of ground, and the full effects of our tightening have yet to be felt. In light of how far we've come in tightening policy, the uncertain lags with which monetary policy affects the economy, and potential headwinds from credit tightening, today we decided to leave our policy interest rate unchanged and to continue to reduce our securities holdings. Looking ahead, nearly all committee participants view it as likely that some further rate increases will be appropriate this year to bring inflation down to 2% over time. And I will have more to say about monetary policy after briefly reviewing economic developments. The U.S. economy slowed significantly last year, and recent indicators suggest that economic activity has continued to expand at a modest pace. Although growth in consumer spending has picked up this year, activity in the housing sector remains weak, largely reflecting higher mortgage rates. Higher interest rates and slower output growth also appear to be weighing on business fixed investment. Committee participants generally expect subdued growth to continue. In our summary of economic projections, the median projection has real GDP growth at 1.0% this year and 1.1% next year, well below the median estimate of the longer run normal growth rate. The labor market remains very tight. Over the past 3 months, payroll job gains averaged a robust 283,000 jobs per month. The unemployment rate moved up but remained low in May at 3.7%. There are some signs that supply and demand in the labor market are coming into better balance. The labor force participation rate has moved up in recent months, particularly for individuals aged 25 to 54 years. Nominal wage growth has shown signs of easing, and job vacancies have declined so far this year. While the jobs to workers gap has declined, labor demand still substantially exceeds the supply of available workers. FOMC participants expect supply and demand conditions in the labor market to come into better balance over time, easing upward pressures on inflation. The median unemployment rate projection in the SEP rises to 4.1% at the end of this year and 4.5% at the end of next year. Inflation remains well above our longer-run 2% goal. Over the 12 months ending in April, total PCE prices rose 4.4%, excluding the volatile food and energy categories. Core PCE prices rose 4.7%. In May, the 12-month change in the Consumer Price Index came in at 4%, and the change in the core CPI was 5.3%. Inflation has moderated somewhat since the middle of last year. Nonetheless, inflation pressures continue to run high, and the process of getting inflation back down to 2% has a long way to go. The median projection in the SEP for total PCE inflation is 3.2% this year, 2.5% next year, and 2.1% in 2025. Core PCE inflation, which excludes volatile food and energy prices, is projected to run higher than total inflation, and the median projection has been revised in the SEP up to 3.9% this year. Despite elevated inflation, longer-term inflation expectations appear to remain well anchored, as reflected in a broad range of surveys of households, businesses, and forecasters, as well as measures from financial markets. The Fed's monetary policy actions are guided by our mandate to promote maximum employment and stable prices for the American people. My colleagues and I are acutely aware that high inflation imposes hardship as it erodes purchasing power, especially for those least able to meet the higher costs of essentials like food, housing, and transportation. We are highly attentive to the risks that high inflation poses to both sides of our mandate, and we are strongly committed to returning inflation to our 2% objective. As I noted earlier, since early last year, we have raised our policy rate by 5 percentage points. We have been seeing the effects of our policy tightening on demand in the most interest rate sensitive sectors of the economy, especially housing and investment. It will take time, however, for the full effects of monetary restraint to be realized, especially on inflation. The economy is facing headwinds from tighter credit conditions for households and businesses, which are likely to weigh on economic activity, hiring, and inflation. The extent of these effects remains uncertain. In light of how far we've come in tightening policy, the uncertain lags with which monetary policy affects the economy, and potential headwinds from credit tightening, the committee decided at today's meeting to maintain the target range for the federal funds rate at 5 to 5.25%, and to continue the process of significantly reducing our securities holdings. As I noted earlier, nearly all committee participants expect that it will be appropriate to raise interest rates somewhat further by the end of the year. But at this meeting, considering how far and how fast we've moved, we judged it prudent to hold the target range steady to allow the committee to assess additional information and its implications for monetary policy. In determining the extent of additional policy firming that may be appropriate to return inflation to 2% over time, the committee will take into account the cumulative tightening of monetary policy, the lags with which monetary policy affects economic activity and inflation, and economic and financial developments. In our SEP, participants wrote down their individual assessments of an appropriate path for the federal funds rate based on what each participant judges to be the most likely scenario going forward. If the economy evolves as projected, the median participant projects that the appropriate level of the federal funds rate will be 5.6% at the end of this year, 4.6% at the end of 2024, and 3.4% at the end of 2025. For the end of this year, the median projection is a half percentage point higher than in our March projections. I hasten to add, as always, that these projections are not a committee decision or plan. If the economy does not evolve as projected, the path for policy will adjust as appropriate to foster our maximum employment and price stability goals. We will continue to make our decisions meeting by meeting based on the totality of incoming data and their implications for the outlook for economic activity and inflation, as well as the balance of risks. We remain committed to bringing inflation back down to our 2% goal and to keeping longer-term inflation expectations well anchored. Reducing inflation is likely to require a period of below-trend growth and some softening of labor market conditions. Restoring price stability is essential to set the stage for achieving maximum employment and stable prices over the longer run. To conclude, we understand that our actions affect communities, families, and businesses across the country. Everything we do at the Fed is in service to our public mission. We will do everything we can to achieve our maximum employment and price stability goals. Thank you, and I look forward to your questions.
Colby. Thank you. Colby Smith with the Financial Times. I'm curious what gives you and the committee the confidence that waiting will not be counterproductive at a time when the monthly pace of core inflation is still so elevated. Interest rate sensitive sectors like housing, while they felt the drag of the past Fed actions, have started to recover in some regions, and financial conditions, most recently were easing.
So, I guess I would go back to the beginning of this tightening cycle to address that. So as we started our rate hikes early last year, we said there were 3 issues that would need to be addressed kind of in sequence. And that of the speed of tightening, the level to which rates would need to go, and then the period of time over which we'd need to keep policy restrictive. So at the outset, going back 15 months, the key issue was how fast to move rates up, and we moved very quickly by historical standards. Then last December, after 4 consecutive 75 basis point hikes, we moderated to a pace of a 50 basis point hike, and then this year to 3 25 basis point hikes at sequential meetings. So it seemed to us to make obvious sense to moderate our rate hikes as we got closer to our destination. So the decision to consider not hiking at every meeting and ultimately to hold rates steady at this meeting, I would just say it's a continuation of that process. The main issue that we're focused on now is determining the extent of additional policy firming that may be appropriate to return inflation to 2% over time. So the pace of the increases and the ultimate level of increases are separate variables. Given how far we have come, it may make sense for rates to move higher, but at a more moderate pace. I want to stress one more thing, and that is that the committee decision made today was only about this meeting. We didn't make any decision about going forward, including what would happen at the next meeting, including we did not decide or really discuss anything about going to an every other meeting kind of an approach or really any other approach. We really were focused on what to do at this meeting.
So there was no kind of initial debate about the possibility of July, any sense of the initial support at this stage for that move?
So again, we didn't make a decision about July. I mean, of course, it came up in the meeting from time to time, but really the focus was on what to do today. I would say about July, two things. One, decision hasn't been made. Two, I do expect that it will be a live meeting.
Thanks, Howard Schneider with Reuters. I was just wondering if you could help us understand the narrative here, because it feels like there's been a level shift in the dots. Stronger GDP, less of a hit to unemployment, slower progress on inflation, and I'm wondering, in this sort of, where's the disinflation coming from?
Sure.
The labor market's going to be stronger, it looks like. It's not coming from there. Demand's not coming down all that fast, according to GDP. You've doubled your estimate of GDP. So what's the narrative here? It seems like it's getting more immaculate rather than more messy.
So you're right that the data came in, I would say, consistent with, but on the high side of expectations. So, and if you go back to the former SEP, the last SEP in March, you will see that growth moved up. These are not huge moves, but growth estimates moved up a bit. Unemployment estimates moved down a bit. Inflation estimates moved up a bit. And, all three of those kind of point in the same direction, which is, that perhaps more restraint will be necessary than we had thought at the last meeting. So, although the level, frankly, is pretty, the level of 5.6 is pretty consistent if you think about it, where the federal funds rate was trading before the bank incidents of early March. So we've kind of gone back to that. So your question is, where's the disinflation going to come from? And I don't think the story has really changed. The committee has consistently said and believed that the process of getting inflation down is going to be a gradual one. It's going to take some time. And I think you go back to the three-part framework for core PCE inflation, which is, we think, as good an indicator as you can have for where inflation is going forward. You start with goods. With goods, we need to see continued healing in supply side conditions. They've definitely improved a substantial amount, but if you talk to people in business, they will say it's not back to where it was. So that's one thing, and that should enable goods prices to continue, goods inflation to continue to come down over time. In terms of housing services inflation, that's another big piece, and you are seeing there that new rents, new leases are coming in at low levels, and it's really a matter of time as that goes through the pipeline. In fact, I think any forecast that people are making right now about inflation coming down this year will contain a big dose of this year, and next year will contain a good amount of disinflation from that source, and that's, again, probably going to come slower than we would expect. That leaves, the big sector, which is a little more than half, pardon me, of core PCE inflation. That's non-housing services, and we see only the earliest signs of disinflation there. It's a sector, it's a very broad and diverse sector. I would say in a number of the parts of that sector, the largest cost would be wage costs. It's the service sector, so it's heavily labor intensive, and I think many analysts would say that the key to getting inflation down there is to have a continuing loosening in labor market conditions, which we have seen. We have actually seen, I go through a number of indicators suggesting there's been some loosening in labor market conditions. We need to see that continue. I would almost say that the conditions that we need to see in place to get inflation down are coming into place, and that would be growth meaningfully below trend, It would be a labor market that's loosening. It would be goods pipelines getting healthier and healthier and that kind of thing. The things are in place that we need to see, but the process of that actually working on inflation is going to take some time.
Nick.
Nick Tamaros of the Wall Street Journal. Chair Powell, what's the value in pausing and signaling future hikes versus just hiking now? I mean, not to be flippant, but I don't lose weight just by buying a gym membership. I have to actually go to the gym. 16 of your colleagues put down a higher year-end 23 rate today. A majority of you think you're going to have to go up by 50 basis points this year. So why not just rip off the Band-Aid and raise rates today?
So first, I would say that the question of speed is a separate question from the question from that of level. Okay, so and I think if you look at the SEP, that is our estimate, our individual. It's really accumulation of our individual estimates of how far to go. I mentioned how we got to those numbers. In terms of speed, it's what I said at the beginning, which is speed was very important last year. As we get closer and closer to the destination, and according to the SEP, we're not so far away from the destination in most people's accounting. It's reasonable, it's common sense to go a little slower, just as it was reasonable to go from 75 basis points to 50 to 25 at every meeting. And so the committee thought overall that it was appropriate to moderate the pace, if only slightly. And there are benefits to that. So that gives us more information to make decisions. We may try to make better decisions. I think it allows the economy a little more time to adapt as we make our decisions going forward. And we'll get to see, we don't know the full extent of the consequences of the banking turmoil that we've seen. It would be early to see those, but we don't know what the extent is. We'll have some more time to see that unfold. I mean, it's just the idea that we're trying to get this right. And this is, if you think of the two things as separate variables, then I think that the skip, I shouldn't call it a skip, the decision makes sense.
I know you said July is live with only one June employment, with only the June employment and the CPI report for June due to be released before the July meeting. You get the ECI after, you get the senior loan officer survey after, you get some bank earnings at the end of next month. What incremental information will the committee be using to inform their judgment on whether this is in fact a skip or a longer pause?
Well, I think you're adding that to the data that we've seen since the last meeting too. Since we chose to maintain rates at this meeting, it'll really be a 3-month period of data that we can look at. And I think that's a full quarter, and I think you can draw more conclusions from that than you come from any 6-week period. We'll look at those things. We'll also look at the evolving risk picture. We'll look at what's happening in the financial sector. We'll look at all the data, the evolving outlook, and we'll make a decision.
Gina.
Thanks for taking our questions. Gina Smilek, New York Times. You obviously, in your forecasts, marked up the sort of path for growth, marked down the path for unemployment, marked up the path for inflation pretty notably. I wonder, since March, what has changed to make you think that the economy is a lot more resilient and inflation is going to be a lot more stubborn? And given that, why do you feel confident that this is as high as you're going to have to revise the federal funds rate, or do you think it's possible we could have even a higher than 5.6% terminal by the end of this cycle?
I mean, on the first part, I just think we're following the data and also the outlook. The economy the labor market, I think, has surprised many, if not all, analysts over the last couple of years with its extraordinary resilience, really. It's just remarkable, and that's really, if you think about it, that's what's driving. It's job creation, it's wages moving up, it's supporting spending, which in turn is supporting hiring, and it's really the engine, it seems, that is driving the economy. So it's really the data. In terms of, we always write down at these meetings what we think the appropriate terminal rate will be at the end of this year. That's how we do it. It's based on our own individual assessments of what the most likely path of the economy is. It can actually, in reality, wind up being lower or higher. And there's really no way to know, but it's what people think as of today, And as the data come in, it can move around during the intermeeting period. It could wind up back in the same place, but it really will be data-driven. I can't tell you that I ever have a lot of confidence that we can see where the federal funds rate will be that far in advance.
Mr. Chairman, thanks for taking my question. You had said back at the end of May that you thought risks were getting closer to being into balance. Is that still the case, or has your mind changed about the balance of risks out there? And also, could you give us an idea of what would be a sufficiently restrictive funds rate? Obviously, the current rate, according to the committee, is not sufficiently restrictive. Is it 5, 6? Is it 6? Where's sufficiently restrictive? Thank you.
I would say again that I think that over time, the balance of risks, as we've moved from from interest rates at effectively 0 now to 5 percentage points with an SEP calling for additional hikes, I think we've moved much closer to our destination, which is that sufficiently restrictive rate. And I think that means, almost by definition, that the risks of sort of overdoing it and underdoing it are getting closer to being in balance. I still think, and my colleagues agree, that the risks to inflation are to the upside still. So we don't think we're there with inflation yet, because we're just looking at the data. And if you look at the full range of inflation data, particularly the core data, you just aren't seeing a lot of progress over the last year. Headline, of course, inflation has come down materially, but as you know, we look at core as a better indicator of where inflation overall is going. Sufficiently, so I think what we'd like to see is credible evidence that inflation is topping out and then beginning to come down. That's what we want to see. Of course, that's what we want to see. And I think it's also, we understand that there are lags, but remember that it's more than a year since financial conditions began tightening. I think the reason we're comfortable pausing is that we are still, much of the tightening took place over last summer and later into the year, and I think it's reasonable to think that some of that may come into effect. So we're, I think stretching out into a more moderate pace is appropriate to allow you to make that judgment of sufficiency, more with more data over time.
Rachel.
Hi, Chair Powell. Rachel Siegel from the Washington Post. Thanks for taking our questions. I wanted to ask further on the lag effects. When you're considering when you would hike again throughout the course of the year, are there things that you would expect to kick in as those lag effects come into effect that would inform your decisions? Have you learned things over the past year that give you some sense of timeline for when to expect those lags to come into effect?
Yeah. So it's a challenging thing in economics. It's sort of standard thinking that monetary policy affects economic activity with long and variable lags. Of course, these days, financial conditions begin to tighten well in advance of actual rate hikes. So if you look back when we were lifting off, we started talking about lifting off. By the time we had lifted off, the 2-year, which is a pretty good estimate of where policy is going, had gone from 20 basis points to 200 basis points. So in that sense, tightening happens much sooner than it used to in a world where news was in newspapers and not on the wire. So that's different, but it's still the case that what you see is interest-sensitive spending is affected very, very quickly. So housing and durable goods and things like that. But broader demand and spending and asset values and things like that, they just take longer. And you can pretty much find research to support whatever answer you would like on that. So there's not any certainty or agreement in the profession on how long it takes. So, and that makes it challenging, of course. So we're looking at the calendar, we're looking at what's happening in the economy, we're having to make these judgments. And again, it's one of the main reasons why it makes sense to go at a slightly more moderate pace now as we seek that ultimate. I can't point to that ultimate endpoint. I can't point to a specific data point. I think we'll see it when we see inflation, really, really flattening out reliably and then starting to soften. I think we'll know that it's working. And ideally, by taking a little more time, we won't go well past the level where we need to go.
I was curious if you could give us an update on what you're seeing on credit tightening since the bank incidents from March and how you're teasing that out apart from these lag effects.
So it's too early still to try to assess the full extent of what that might mean. And, that's something we're going to be watching, of course. And, if we were to see what we would view as significant tightening beyond what would normally be expected because of this channel, then, we would factor that into account in making rate decisions. So that's how we think about it.
Let's go to Chris.
Thanks. Chris Rugaber at Associated Press. You mentioned that many of the trends are in place that you want to see. Core services ex-housing has come in pretty low in the past couple of months. And as you noted, a significant portion of core inflation is now housing prices. And then we've had some quirks in used car prices. So given that these trends are in place, I guess I'm sort of asking the flip side of Nick's question, why signal additional rate hikes? Aren't things headed in the direction you need? Why not simply give it even more time? Or it's surprising to see so much hawkishness in the dots given what we're seeing recently.
Yeah, so, we've, remember, we're 2.5 years into this, or 2.25 years into this, and forecasters, including Fed forecasters, have consistently thought that inflation was about to turn down, and typically forecasted that it would, and been wrong. So I think if you look at core PCE inflation overall, look at it over the last 6 months, you're just not seeing a lot of progress. It's running at a level, over 4.5%, far above our target, and not really, moving down. We want to see it moving down decisively. That's all. Of course, we are going to get inflation down to 2% over time. We don't want to do. We want to do that with the minimum damage we can to the economy, of course. But we have to get inflation down to 2%, and we will. And we just don't see that yet. So, hence you see today's policy decision, both to write down further rate hikes by the end of this year, but also to moderate somewhat the pace with which we're moving.
Quick follow-up. I mean, the last press conference you mentioned you didn't see wages driving inflation, and there was some research from the San Francisco Fed suggesting wages aren't necessarily a key driver, but you've talked about the labor market today and the need for softening. Can you give us a little more specifically of how you see the tight labor market driving inflation at this point? Thank you.
Right. So I'm not going to comment on any particular paper, but I would say that I think the overall picture is that at the beginning, in early 2021, inflation was really coming from very strong demand largely for goods. People were still at home. They had money in the bank, and they wanted to spend, and they spent a lot on goods. And of course, at the same time, and because of that high demand to some extent, supply chains got all snarled up. So prices went way up, inflation went way up. So that was the origin, and it wasn't really particularly about the labor market or wages. But as you moved through 21 into 22 and now in 23, I think many analysts believe that it will be an important part of getting inflation down, especially in the non-housing services sector, to getting wage inflation back to a level that is sustainable, that is consistent with 2% inflation. We actually have seen wages broadly move down, but just at a quite gradual pace. So, and that's a little bit of the finding of the Bernanke paper with Blanchard of a few weeks ago, which is very consistent with what I would think.
Go to Michael McKee.
Michael McKee from Bloomberg Radio and Television. You said in the past that you don't like to surprise markets. It's kind of been the Fed's view. Markets should have an idea of what you're going to do before you go in. You also said a number of times that it would take a while to bring inflation down. You reiterated that again today, and that we would get to a point where inflation could be sticky. So I'm wondering, as we go into the next meetings, how Wall Street or others should look at your reaction function. What will you be reacting to, time or data? In other words, if nothing much changes, if we're looking at the same sort of labor market, the same sort of inflation levels in July or in September or November, Will you move because you've said you feel you need to? Is it time that's going to require additional movement, or would it be a reversal in inflation?
So I don't want to deal with hypotheticals about different ways data might move out. So we of course we don't go out of our way to surprise markets or the public. At the same time, our main focus has to be on getting the policy right, and that's what we're doing here, and that's what we'll do for the upcoming meetings. I will say the July meeting will be live, and we'll just have to see. I think you'll see the data, you'll hear Fed people talking about it, and markets will have to make a judgment.
Well, do you think inflation is likely to continue coming down based on the lags and based on your threat of additional movement, or are we going to be in a period where we're not going to know what's happening?
I think if you look at, if you just look at, I'll just point you to the forecast. So inflation is running, core PCE inflation is running at about 4.5%, a little higher than 4.5%, and the median FOMC participant thinks it'll go down to 3.9 on a 12-month basis. This is by the end of this year. So that's expecting pretty substantial progress. That's a pretty significant decline for half a year. So that's the forecast. We do try to be transparent in our reaction function. We're committed to getting inflation down, and that's the number one thing. So that's how I think about it.
Let's go to Victoria.
Victoria Guido with Politico. Could you talk about the balance sheet and how you're thinking about it? What are you looking for to judge whether we're approaching reserve scarcity, and is Treasury issuance going to affect that? Also, are you considering lowering the RRP rate in order to take some pressure off banks?
So let me say, first of all, on the Treasury part of it, if I can talk about that, and then go back to the balance sheet. So on that, of course, we've been very focused on that for a couple of months, as everyone has. Treasury has laid out its borrowing plans publicly. I think I saw the Secretary's comments yesterday to the effect that Treasury has consulted widely with market participants about how to avoid market disruption, and that they're going to watch carefully for that. So that's from the Treasury, which actually sets the borrowings. At the Fed, we'll be monitoring market conditions carefully as the Treasury refills the TGA. The adjustment process is very likely to involve both a reduction in the RRP facility and also in reserves. It's really hard to say at the beginning of this which will be greater. We are starting at a very high level of reserves and still elevated RRP to take up, for that matter. So we don't think reserves are likely to become scarce in the near term or even over the course of the year. So that's the Treasury part of the answer. We will, of course, continue to monitor conditions in money markets, and we're prepared to make adjustments to make sure that monetary policy transmission works. Was there another part of your question?
Yeah. What are you considering lowering the RRP rate to help take some pressure off banks?
So we have a number of, I would say, the RRP doesn't look like it's pulling money out of the banking system. It's actually been shrinking here lately. So I don't think that's not something we've thought about a lot over time. It doesn't really look like that's something that we would do. I think it's a tool that we have. If we want to use it, we can. There are other tools we can use to address money market issues, but I wouldn't say that that's something that's likely that we would do in the near term.
Janelle Marte with Bloomberg. Have you seen sufficient cooling in the housing market to bring inflation down? For example, how does the recent rebound affect your forecasts, and how does it factor into monetary policy?
So certainly housing, very interest sensitive, and it's the first place really, or one of the first places that's either helped by low rates or that is held back by higher rates. And we certainly saw that over the course of the last year. We now see housing putting in a bottom and maybe even moving up a little bit. We're watching that situation carefully. I do think we will see rents and house prices filtering into housing services inflation, and I don't see them coming up quickly. I do see them kind of wandering around at a relatively low level now, and that's appropriate.
Do you think you'll have to target that with further rate increases?
Well, I think we look at everything. We don't just look at housing. So I think, the way it works is individual participants sit in their offices all over the country and they write down their forecast, and including their most likely forecast, including their rate forecast, and then they send it in on Friday afternoon, and we accumulate it, and then we publish it for you. So that's how they do that. Well, I don't know that housing is itself going to be driving the rates picture, but it's part of it.
Let's go to Edward.
Thank you for taking the question, Mr. Chairman. Edward Lawrence with Fox Business. So I want to go back to comments you made about in the past about unsustainable fiscal path. The CBO projects the federal deficit to be $2.8 trillion in 10 years. The CBO also says that federal debt will be $52 trillion by 2033. At what point do you talk more firmly with lawmakers about fiscal responsibility? Because I'm assuming monetary policy cannot handle alone the inflation or keep that inflation in check with the higher level of spending.
I don't do that. That's really not my job. We hope and expect that other policymakers will respect our independence on monetary policy, and we don't see ourselves as the judges of appropriate fiscal policy. I will say, and many of my predecessors have said, that we are on an unsustainable fiscal path, and that needs to be addressed over time. But I think trying to get into that with lawmakers would be kind of inappropriate, given our independence and our need to stick to our knitting.
Is there any conversation then about the Federal Reserve financing some of that debt that we're seeing coming down the pike?
No, under no circumstances.
Courtney.
Thanks for taking our questions, Chair Powell. So looking at the SEP, it looks like GDP for this year was raised significantly, your forecast for GDP this year. The unemployment rate, meanwhile, was pulled downward. And so should we take that as a sign that the committee is more confident about the prospects of a soft landing, at least as it relates to what you were expecting in March?
I would just say it this way, that I continue to think, and this really hasn't changed, that there is a path to getting inflation back down to 2% without having to see the kind of sharp downturn and large losses of employment that we've seen in so many past instances. It's possible. In a way, a strong labor market that gradually cools could aid that along. It could aid that along. But I guess I want to come back to the main thing, which is, though, simply this. We see the committee, as you can see from the SEP, the committee is completely unified in the need to get inflation down to 2%, and will do whatever it takes to get it down to 2% over time. That is our plan. And we understand that allowing inflation to get entrenched in the U.S. economy is the thing that we cannot allow to happen for the benefit of today's workers and families and businesses, but also for the future. Getting price stability back and restored will benefit generations of people as long as it's sustained, and it really is the bedrock of the economy, and you should understand that that is our top priority.
Just a quick follow-up on that. I'm just a little confused because you said the committee will do whatever it takes to get inflation down over time. But when I look at the SEP, inflation is still projected to be elevated next year, but the Fed funds rate is lower than where it is now. Can you help me understand that?
Sure. So, if you look 2 and 3 years out with the forecast, first of all, I wouldn't put too much weight on forecasts even 1 year out, because they're so highly uncertain. But what they're showing is that as inflation comes down in the forecast, if you don't lower interest rates, then real rates are actually going up, right? So just to maintain a real rate, the nominal rate at that point 2 years out, let's say, should come down just to maintain real rates. And actually, since we're probably going to we're having real rates that are going to have to be meaningfully positive and significantly so for us to get inflation down. That probably means that certainly means that it will be appropriate to cut rates at such time as inflation is coming down really significantly. And again, we're talking about a couple years out. I think, as anyone can see, not a single person on the committee wrote down a rate cut this year. nor do I think it is at all likely to be appropriate if you think about it. Inflation has not really moved down. It is not so far reacted much to our existing rate hikes, and so we're going to have to keep at it.
Julie.
All right, you've been listening to the chairman of the Federal Reserve, Mr. Jerome Powell, briefing members of the press after the Fed's announcement of no rate hike for the first time in nearly a year and a half. I'm J.D. Durkin. We are live on the floor of the New York Stock Exchange with the context you need on today's announcement and, of course, what it means for you. At this hour, markets a bit in mixed territory. The NASDAQ in the green, the S&P in the green, though fractionally. The Dow weighted down largely by UHC. The S&P currently holding above that 4,300 level we've been tracking now for several days. All this comes after 2 days of new inflation data that showed a better picture than some had expected. CPI data yesterday showing inflation rising at a 4% annual rate, the lowest in 2 years, but a bit of a less optimistic picture on core CPI, something the chairman spoke about moments ago. Earlier today, we also got wholesale PPI data that showed prices falling for the third time in the last 4 months. In just a moment, we will be joined by Jay Woods, a legend. Yes, a legend of the New York Stock Exchange. I told you I'd work that in there.
Yeah, that was great.
But first, a quick recap of what we know and what we learned in the last hour. At 2 o'clock, the Fed announced, if you can call it, a hawkish pause, which markets had largely been expecting, with the Fed not only leaving open the possibility of additional hikes later in the year, but actually expecting it. The expectation for the federal funds rate is now 5.6% for the end of 2023. The central bank has 4 more meetings in 2023, July 26th, September 30th, or 20th rather, November 1st, and finally the 13th of December. Time now to welcome in our special guest of the afternoon, Mr. Jay Woods, Chief Global Strategist at Freedom Capital Markets and to CMT, in other words, in the Chartered Market Technician Program. Thank you for being here.
Hey, JD, it's great to be here. The legend from Villanova sitting next to me now, so that's fantastic.
Thank you for working that in. I appreciate
no
it.
problem.
So I know you've been right here near the desk with me, listening into what Powell had to say. Any surprises versus your expectations coming into the day?
The surprise right now is the price action we're seeing in the market. I always say the first move is the wrong move, and it was wrong again, but I mean, we still have 30, 45 minutes to go. I am, kind of sad that I'm stuck with you and I can't be in my booth watching the action because I think this last half an hour has potential to really dictate where we go over the coming weeks. But the hawkish pause, that's what we're going to get out of this. And it's very interesting. The one thing he's been doing this whole time, he's been telegraphing every move. And he telegraphed every rate hike. And this one, he telegraphed the pause. It was not a surprise. The tone, not necessarily a surprise either, but the press conference, he struck the right tone. And you can see the way the market is acting that, okay, yes, we're hawkish. The dot plot is indicating when we go 5.5, 5.6, which is a little scarier and a little more than we expected here. But no one is being rattled by this, and I'm kind of surprised.
In terms of the technicals, what do you usually look for as we are in the 3 o'clock hour on Fed days like this?
Well, the technicals, we look for reversals, and we are still in the process of seeing how this day shakes out. I like to take a big picture approach, and I look at where we've come into this meeting. And if you look from June 1st, 10 trading days, the Russell 2000, which is down 1% still, up 8%. We're seeing that rotation. We're seeing nice rotation, great price action. We watched that 4,200 level forever in the S&P 500. We broke above it. We've gone about 4.5%, almost 5% above that. That is what I'm watching. If we get a pullback, which I think we're due for, I really think, it's a natural thing to see a pullback. Does the old high hold, 43.25? We're about 43.60 right now. If not, 4,200, that old resistance being support. I think that would be healthy to go back and retest it. What's surprising me is we aren't pulling back just yet. Now, it's still early. We still have time to go. But he struck the right chord, even though everything he said was super hawkish. And the dot plot leads us to believe that this 5.25 rate that we thought would be the ceiling may not be the floor in the Fed fund rates for the rest of this year at least.
Yeah, that's right. Expectations there may be as high as 5.6 or so, depending for the end of the year, right? We always follow, if you go through the PDF that gets released by the FOMC right at 2 o'clock, you got to go through and start digging through the information. Then, of course, we get the question and answer, which is always fun to listen to, right? Because
I love the Q&A.
He's got this statement, and he's got to be by the book. He's got to be by the word, because he knows we're all going to look through word for word. And then the Q&A portion, My man's got to be off book. It
Every
gets a little
word
more
is-
difficult, right?
Yes, no doubt about it. And every word is important. And he said the word skip. And all of a sudden, I was like, oh, and then he walked it back
Yeah, he
quickly.
did. Yeah, he did.
Quickly.
He's a guy I shouldn't say skip.
Yeah, but I tell you what, we're going to be talking about that word skip for a long time to come because he actually fed that narrative by just blurting it out. And that's unlike him to blurt something out. So keep an eye on what we say about skip, and does that mean July is set? But the real tone was this. He said, we're finally taking a pause, something I thought we should have done a while ago. 10 straight rate hikes. Let's, step on the brakes a little bit, digest the data. So they're digesting things. And, the core CPI, things are coming down, things are cooling. Unemployment finally ticked up. It's the lagging indicator there. You don't want to root for it to tick up, obviously, but things are trending in the right direction, that the economy's slowing, not at the rate you would expect, going 5% in 10 rate hikes in a year and a half, as you said, to lead off the show. So let's see. One cycle, it'll be a full quarter of data, and the Fed speakers will be on the road the next couple weeks, and I'm sure you're going to hear a lot of different things. But Powell has always been true to his word, and he's telegraphed it that we're going to watch the data and see where we go. But he was hawkish, meaning we could go a quarter point.
And he did say that we thought it was prudent, was the word that he used, to do a pause, some of those lagging indicators, which reporters have pressed him on over all these last few press conferences, Jay. He's now saying, yeah, look, we understand some of these lagging indicators will take a while, whether, the efforts of price stability or unemployment to catch up. We thought it was prudent to have this skip, walk it back, and then we kind of see what happens. Had you been in the room,
okay,
what question would you have wanted to ask the chairman?
I think the Wall Street Journal asked the question I want. Why, if we are, not where you want to be at this point, a pause or a skip where he actually fumbled on the word, and why not just rip off the Band-Aid and get us to where we have to go? I wanted to hear his reaction to it. I liked his answer. I've been in the pause camp prior to this pause. So that would be what I wanted to know. And then I'm looking forward, not after this meeting in July, but Jackson Hole in August. Because if you recall last August, that's when he came out and he went into a bunker. He wasn't out in Bucolic, Wyoming in front of the ranch with the beautiful setting. He went into a bunker and said, no, we're not done. There's a long way to go. And he hasn't patted himself on the back. The market is patting him on the back right now because we are now 20% off the lows. We're a new bull market officially, and we're not seeing that action. Now, I'm going to look up at the screen because we are starting to sell off, and that's what I expect us to do over the last half hour once he moves off the stage and try to retest that 43.25 level in the S&P 500. I'd be more surprised if we didn't. And then the NASDAQ action is unbelievable. Seeing that we are still in that rate hiking cycle, those would affect the growth stocks the most. And nope, they're still at 52-week highs as well.
And you and I were talking before we came live. The Dow's in a little bit of a unique situation today with United Healthcare. Yeah. Right, so it's not maybe the S&P and NASDAQ a bit of a better read for you on the technicals.
Yeah, we quickly did the math.
This particular afternoon.
Yeah, we were doing math here on the set. Each point in United Healthcare is about 6.5 point drag on the Dow. It's down 34 points. That's your entire loss. So you take out United Healthcare, the Dow is relatively flat. And, it's sector by sector within the Dow. But when it's a price-weighted average and the highest priced stock is United Healthcare, it's going to drag it. So, to me, I look at the Russell, I look at the S&P 500, and that's more indicative of what's to come. The S&P 500 is down marginally 5 points. Given the run we've had, they're taking this in stride, and I'm surprised we didn't get more of a sell-off.
You've been doing this a long time, and I say that with respect, and that's why I call you a New York Stock Exchange legend. Yeah. You mentioned Fed speakers 2 answers ago, and I wonder if in your long career of doing this, as esteemed as it is, have you ever seen a time where everyone pays such close attention to every single member of the Fed, even the non-voting members? Get a lot of headlines, they speak, and everyone listens. We all read our headlines, we talk a lot about it, or is this how it more or less has always been?
This is not how it's always been, and now you're really aging me, and I hate you for that. No, I mean, in this digital age, in the age of social media, in the age of people liking to get in front of cameras. Neil Kashkari is not shy about cameras when there's one there to talk his mind. Yes, it is very true. These sound bites play and markets move on every little soundbite. No, when we were doing this in the 90s and the early 2000s, and we were watching Greenspan's briefcase and what papers were hanging out, and that was the tell. There was no Twitter, there was no social media to see what's going on, and they kept it really close to the vest. There were more surprises in rate hikes, surprise rate cuts along the line, and that's why I respect Jay Powell for what he's been doing. He's been very transparent. He hasn't always been right. Let's go, transitory inflation.
Transitory.
We don't forget that down here. But right now, he continues to tell us exactly how it's going to go. And if something changes, there's a convenient link to the Journal, and we're ready for it here. But the market has been taking it in stride, and lack of volatility is the story of this afternoon. We had the initial reaction, and now we're flat. It's odd.
I'm glad you mentioned volatility. Let me ask you about quad witching this Friday.
Yes.
Right? It's a crucial day. Talk about volatility. We get a lot of high volume, especially in that crush of Friday afternoon. For people who might be a bit unfamiliar, give me the layman's guide quickly to what quad witching is, or at least why you follow it so closely and what you will be looking for this Friday the 16th.
Well, we follow it very closely because it's the options expiration day, and that close means more to the traders down here and to people that have these positions than anything, and they all expire. So we are going to see a spike and surge in volume, not only this Friday with the quad witch, and that's a 4-time event, third Friday in March, June, and then I have to add 3 months. You
Right.
know the
Not fair,
December,
yeah.
then what's in between there? September.
Yeah.
This is how my brain
I think
works.
that's right,
It's a little
yeah.
backwards. It is right. It's
That's
just
fair.
the way I got there was a little off.
It
But no,
works.
the quad witch is a big event, and as someone that traded down here for 28 years, those closes can be chaotic. And then we have another big close that not enough of you guys are talking about. The Russell reconstitution a week from Friday. The Russell's been the story that no one talks about down here, up 8%. It was the lagging index that, you have the NASDAQ up 30% and 2,000 of the small cap stocks are doing nothing. They lifted their heads, and they lifted their heads as we're rebalancing that index. So up 8%, now 7 because it's down 1% today. As we head into their rebalancing, it's going to be very interesting, and you're going to see a lot of action behind you on this floor that day as well.
I'm looking forward to that, for sure. To another big picture view is, of course, the R word, recession. Will it happen? Will it not? If we do have it, albeit maybe less of an impact one than some people had been previously fearing. You recently said that if there is a recession, history may look back at it as a recession with an asterisk. What does that mean, Jay?
Well, the recession with an asterisk. This is the most telegraphed recession we've ever had. Everyone predicted a recession. I predict a recession. But the way the recession is factored in, I learned it was 2 negative quarters of GDP in a row. We had that. Inverted yield curve always leads to a recession. We've had that. We're in the sweet spot where recessions usually happen after the yield curve inverts, and then the jobs number. So it's the NBER that decides what is officially a recession.
Right.
Well, the asterisk is COVID. COVID changed everything. We've had rolling recessions and crazy moves in different sectors, different industries for the last 2.5 years. Remember lumber when that was out of control? Food, energy, we had the gas prices last year. We were paying over $5 a pump here in New Jersey. Well, here in New York and New Jersey. And then we had eggs, up through the roof, down now 13% in the last 2 days. So you're seeing rolling recessions in different pockets of the economy. The one thing that's hold true is the jobs number. So when they finally say we're in this recession, I think we're too far off the lows to do what we normally do in a recession. 9 out of the last 10 recessions, we've made new lows in this market. I don't think we'll make a new low if we officially hit that recession. And when you look back at it, it's unlike any recession we may have ever experienced if we actually get the official word.
If we do, and always keeping in mind the NBER, the dating committee, it's really retroactive, right? I mean, you're almost a year into the future when they say, oh yeah, by the way, we hit a recession and we did it like 12 or 14 months ago.
Yeah, exactly. We right now are in a recession when they finally date this back to January. Who knows?
And that was the case in 08, and I think that's an important timeline for people who wonder whether or not we are in it. They kind of look at backwards looking data, make an assessment to say, oh, actually it was September of last year or whatever it is.
Exactly. And this is where price action, to me as a technician, really tells you what's going on. All right, we're making 52-week highs, and we're seeing more and more. We're seeing sectors like the Russells, sectors like the transports, another sector no one talks about. breaking out and challenging. It's turning. But we're seeing a lot of bottoming formations here in the market. And to me, this is progress. I don't know if this is going to be the catalyst to take us to a new leg higher, go to that 4,500 level in the S&P 500. I still think we retest the 4,200 and then 4,325, of course, before we go much higher than this. But, all signs are pointing to the market digesting this rather well today.
At 43.71, as you and I sit here. One thing you and I have not talked about, but at least was released by the Fed officials earlier today, the banking crisis. Talk to me about your sense is the worst behind us, for people wondering to say that was a really big storyline for a while, and now maybe it's been a little bit since anyone's really talked about it.
Yeah, he did mention it briefly, very briefly. I think the banking crisis was caused by too far too fast, and some banks not really preparing for that. This pause, I hope, is helpful in abating any more fears that there will be another bank. May 4th, May 5th, those were the lows in the regional banks. And it was a Thursday going into a Friday, Cinco de Mayo, where we thought two more Western regional banks, Western Alliance and Pac West, I believe, were the two, were going to go that weekend. It seemed like every weekend there was one. Right. They averted it, and things have subsided. Now, if I look at the price action there, we've actually gotten back above the low from the first leg down when the crisis started, when we're talking Signature Bank and Silicon Valley Bank. So to me, I think we've avoided the worst. There's still a long road back for some of these banks, but for me, this is not a concern right now, no.
Jay Woods, as you and I are sitting here on the floor of the NYSE having this conversation on Fed Day, the average viewer may be wondering, why should I care? What does any of this mean to me? What does this mean for the average person that may not follow the technicals so closely, may not follow the business headlines? I want people to have some takeaway to say, well, what does this mean for me and my money?
Well, the average viewer shouldn't care because they're long-term investors. They, if they're trading the Fed news right now, then they're like, how I was years ago back here, and all these people trading every tick and every headline and every news story that comes up on your Twitter feed. Right. No, the long-term investor wants to see where we're going in rates. Are we closer to the end of the cycle? Yes, we are. Is it over? No. But we're seeing progress in that, and then we can finally stabilize. So for the longer-term investor, for the people watching this home that are interested in this, it's fascinating. I love it. We can talk about it all day, especially you and I, as we do in the cafeteria from time to time.
Yes, we do.
But this is just one event that could have moved the markets. I really thought this could have been a pivot day, and it's showing me it wasn't. And I am surprised by the price action. And it still holds true to form. The first move is the wrong move. The S&P 500 was down 30. Not a big move, still above its old highs. And what did we do? We reversed on Powell speaking. That's odd. That's odd.
Finally, you gave me a bit of an answer to this earlier. Anything else in this overall landscape, this whole conversation, everything we've talked about today, that you think maybe we're not talking enough about, especially the talking heads like me that you say, talk about the headlines every day. We follow every little tick, every little bit of data point to give people context. But what do you think overall is saying, God, I really wish we had more of an emphasis on this?
Yeah, I think we focus too much on the big cap stocks, the Magnificent Seven, stocks that I have in my long-term portfolio.
The flashy names.
Yeah, hey, listen, everyone has an iPhone. Everyone knows Apple's 7.25% of the S&P 500. Those are important things, but it's underneath the surface. That rotation, the rotation that we're seeing, financials come back, regional banks breaking back above a key level, old support, new resistance, that's a positive. Industrials acting well, transportation's acting well. Watch FedEx next week. FedEx reports on Tuesday after a nice 3-day weekend. That stock has made a tremendous comeback. It's got a lot of room to reverse. If we see FedEx, if we see stocks like CSX, Expedia, these are names in the transporter that I'm watching. No one cares about Kirby or Matson either. They're shippers, but you like a shipper, it's turning around slowly, and we're starting to trend in the right direction. These are the leadership. These are the stocks that will follow the leadership. Everyone complained about 7 leaders, and that's it. Well, what do? You usually follow the leaders into battle. The leaders don't retreat with the troops, and the troops are starting to follow, and I like it.
You dropped gem after gem on this broadcast. Are you aware of that?
I'm just talking like I normally talk, so.
My special thanks there to a legend of the New York Stock Exchange. One more time, Jay Woods, for taking the time. Thank you very much. Go New York Giants, right?
No, go Birds, and we'll talk during the season.
I tried to sneak that one in there. That's going to do it, my friends, for the special Fed Day broadcast. Stick with TheStreet.com for more on this and all of the major market stories that matter to you.